Imagine waking up and boom, your money is gone. Not because you bought something, but because the stock market crashed. Scary, right? But here's the truth. Stock market crashes happen, and while they can be painful, they also make some people rich. Think about it. In 1929, the Great Depression destroyed fortunes. In 2008, banks collapsed and panic took over. In 2020, COVID-19 hit, and stocks fell like a rock. But guess what? While most people freaked out, some investors stayed calm, and some even made money. How? Because they understood one simple thing: crashes don't last forever. In this video, we're breaking down why market crashes happen, the biggest crashes in history, and how you can protect yourself or even make money when the market goes crazy. If you've ever been scared of a crash, this will change the way you think forever. Let's get into it. Section 1. What are stock market crashes? Really? Stock market crashes are like earthquakes. They shake everything, but they don't hit the same way every time. Let's look at some of the biggest ones in history. 1929, the Great Depression. The market dropped 89%. People lost their life savings. Why? Too much gambling on stocks and no rules to protect investors. 2000, the dot-com crash. Everyone was buying internet stocks, even companies that weren't making money. When reality hit, the Nasdaq fell 78%. Dreams were wiped out. 2008, the housing crash. Banks gave loans to people who couldn't pay. When the system broke, stocks fell 50%. It became a worldwide financial crisis. 2020, COVID-19 crash. The virus spread fast. So did fear. Stocks dropped 34% in just a few weeks. But then something strange happened. The market bounced back. Fast. Thanks to government help and low interest rates. Section 2. Why do stock market crashes happen? Let's break it down. Stock market crashes don't just pop up out of nowhere. There's always a reason or a mix of reasons that causes things to fall apart. Most of the time, it starts with two powerful emotions: greed and fear. First, let's talk about greed. When times are good, people start to think the good times will never end. They see the market going up, so they jump in. Then they see their friends making money, so they invest more. Some even borrow money they don't have just to buy more stocks. That's what happened in 1929, before the Great Depression. People kept buying stocks, even when prices were too high. There were no safety rules. It was like gambling. Same thing in 2000, with the dot-com bubble. Everyone was crazy for internet stocks. People invested in companies that weren't even making money just because they were online. Then, in 2008, banks were handing out home loans to people who couldn't pay them back. That created a big housing bubble. Prices went way too high, and when reality hit, everything fell. So yeah, greed pushes prices up too fast. People ignore warning signs. They think they can't lose. But eventually, the bubble pops. Then comes fear. Once prices start to fall, panic spreads like wildfire. People see the market dropping and think, "I'm going to lose everything." So they sell. Fast. Even if they own good companies, they sell anyway, just to feel safe. That panic selling causes the market to drop even more. It's like a stampede. Everyone's rushing for the exit at the same time. This makes the crash worse. But emotions alone don't cause the whole thing. Real economic problems play a big role too. Let's look at a few. High inflation. When prices of everything go up, your money loses value. Governments raise interest rates to fight inflation, but that makes borrowing money more expensive. Businesses slow down. Stocks drop. Unemployment. When people lose jobs, they spend less. Companies earn less. Stock prices fall. Recessions. The economy slows down. Growth stops. Confidence drops. Investors get nervous and they start selling. Government mistakes. Sometimes central banks raise interest rates too fast, or they wait too long to respond to a crisis. That creates uncertainty, and markets hate uncertainty. Surprise events, things like wars, pandemics, or natural disasters can crash the market in a flash. Think of COVID in 2020. One day, things were normal. The next, lockdowns hit, travel stopped, and stocks tanked. So here's the main idea. Crashes happen when fear meets real problems. If you only had one or the other, the market might dip a little. But when fear and real trouble hit at the same time, that's when crashes happen. Section 3. How smart investors prepare for crashes. When a crash hits, most people panic. But smart investors? They're calm because they're prepared. Here's how they do it. First, they keep some cash saved. Not all their money is in the market. Why? So when prices crash, they can buy good stocks at discount prices, while everyone else is scrambling to sell. Second, they diversify. That means not putting all their money in one stock or one industry. They spread it out across tech, healthcare, real estate, bonds, so if one area crashes, the others might hold steady. Third, they pick strong companies. They don't chase hype. They invest in businesses with real profits, low debt products people always need. These companies usually survive crashes and come out even stronger. Fourth, they use dollar cost averaging. They invest the same amount regularly, no matter if prices are high or low. This keeps their emotions out of it and builds wealth over time. Finally, they stay calm and think long-term. Smart investors know the market has always bounced back, every single time, so they don't panic. They stick to their plan. They're not trying to time the market. They're giving it time to work. Bottom line? Smart investors prepare before the crash, so when it comes, they're ready to act, not react. Section 4. Timing the market? Don't do it. Trying to time the stock market, guessing the perfect moment to buy or sell, is like trying to catch a falling knife. You might get lucky once, but most of the time, you're going to get hurt. Even the pros can't time it perfectly. The market moves fast. News changes everything in seconds, and if you wait too long, the best days can pass you by. Let me give you a real example. If you invested $1 million and just stayed in the market, even through crashes, you'd build serious wealth over time. But if you missed just the 10 best days in the last 40 years, you'd make half as much money. Why? Because the biggest jumps often happen right after the biggest drops. And that's when most people are too scared to invest. So if you're always trying to wait for the right time, you'll likely miss out. Smart investors don't try to be perfect. They know the secret is consistency. They invest regularly through the ups and the downs. It's like planting a tree. You don't dig it up every time it rains. You water it, give it time, and let it grow. That's how real wealth is built, not by chasing the market, but by sticking with it. So don't stress about timing. Focus on time in the market, not timing the market. That's how patience beats panic, every time. Crashes test every investor. But history shows they also bring the best opportunities. If you prepare now, you can be the person who buys low and wins big. So ask yourself, do you have some cash set aside to invest during a crash? Is your portfolio diversified? Are you investing in strong, real businesses? Set up auto investments. Build your plan. And most of all, stay calm when others panic. The next crash will happen. Will you be ready? If this video helped you, hit that like button, subscribe, and turn on the bell so you don't miss future videos. Got questions or want more videos on this topic? Drop a comment below. Thanks for watching, and I'll see you in the next one.